we're doing something a little different now. We're gonna have a little debate. And before we get started, I actually want to thank Matt Hammerstein from Barclays for being willing to come to a P2P lending conference to talk about how P2P lending is going to take over banking. So thank you very much, Matt.
Pleasure.
So why don't we, let's just get started. Give a bit of background about yourself and just your initial kind of perspective on P2P lending, and where, like, basically we want you to state your argument for in your introduction.
Defend myself on behalf of an industry. So my name is Matt Hammerstein. I work at Barclays, lead a team that looks across our activities in customer servicing, digital channels, what we call our information business, which is our sort of play into big data, and then some strategic transformation activity that we're trying to drive across the business. I work in a particular part of the bank called personal and corporate banking, which is everything from high street banking through to private banking through to startups and large corporates. So on peer-to-peer lending, I think there's a couple of things that stand out to me. One is clearly the fact that there is already an existing alternative finance market suggests that there are different needs that customers have that banks don't necessarily fulfill very well. I think the peer-to-peer market has played into that and extended it quite significantly and is growing quite rapidly. I think as an industry, we need to recognize what that tells us about how our customers feel about both the quality of the products that they get from traditional banks, as well as the quality of the service they get around those products. And we've got to recognize that the market's telling us something isn't working, at least as far as the existing players are concerned. I think the fact that peer-to-peer is doing that is healthy for the overall system. So therefore, it's something that I think as an institution and certainly as an individual I look at as a good thing, because it's encouraging more competition in the marketplace and it's helping foster a better environment for borrowers who ultimately are going to be the heartbeat of the economy, and that's ultimately going to be good for everybody. I think as banks, I think the specific things that it tells us that we need to do is figure out how to go faster, how to make our operations both less expensive so we can compete on cost-income ratio basis, as well as better service. And that's a difficult equation, I guess, for traditional banks to try to figure out, given they've had, in our case, 325 years to try to get it right and haven't quite got it right yet. And then three, they tell us that we've got to figure out how to make technology work on behalf of the customer as a part of that, in a way that I think some of the larger, more established and faster growing peer-to-peer lenders have done, and they've leveraged, I think, really technology to create a much better service experience, not just a cheaper one. And that's, again, not something that I think banks have got a lot of evidence yet for demonstrating how they do that on a sustained basis. You know, my premise is, do I think peer-to-peer is here to stay? I think, you know, alternative finance is already here, so as a part of an alternative finance marketplace, peer-to-peer is here to stay. Is it going to continue to grow? I would expect it to do so, and I think banks have got to get their act together quickly if they want to have a realistic chance of making sure that they, if you will, protect their market share in the right way.
Okay. Well, Cormac, I mean, in your presentation yesterday, you certainly laid out several ideas of how P2P lending is going to take over banking. So why don't you just introduce yourself for those who didn't? Maybe you could just recap a little.
Yeah, sure. So my name is Cormac Leech. I work in investment bank Liberum. You know, I focused on this direct lending space for the last 2 years. Been a banks analyst covering Barclays actually for the best part of 10 years at RBS. I covered Barclays from RBS, and I covered Goldman Sachs from JP Morgan. So I've worked at banks for 20 years, so I have a pretty good idea about how the incumbents operate. Yeah, so I mean, you know, I think this community probably knows the kind of the other side of the debate, and to some extent, it doesn't really feel like a debate. It almost feels like you kind of agree with us, actually, that this sector is going to grow quite a lot. But I mean, the kind of the well-worn arguments that probably everybody in this room already is familiar with, that, you know, so we've had vast credit innovation, right? So we've had the unbundling of the whole credit underwriting system. You know, you've got credit agencies like Experian, Equifax, you know, that basically have put all the data out there, you know, due in large part to the banks basically cooperating to make that information available. And then you've got companies like Yodlee that give you real-time view of people's bank statements. You know, if you can actually get a real-time look with a high degree of confidence that what you're looking at is real data for the last 3 months of data, you know, for any individual prospective borrower, you have very good visibility in terms of the cash flow, the ability of that borrower to repay, and then there are other interesting companies like Visual DNA that are going one step further. They're starting to not just gather up all this data that's available around us thanks to the internet, but they're going one step further. They're starting to look inside the minds of the borrowers, right? So, a borrower applies and, they put the name through the database. The guy turns up, you don't have any data, right? So he's on-scored. It turns out you can actually do some psychometric profiling. You can actually ask the guy 30 questions, and based on the way that he answers those, based on 30 years of psychology, they can actually figure out the propensity of that guy to repay. So that's just an example of credit innovation going, one step further. And, one kind of key thing that I think the banks really need to take into account is that, banks operate with 3 or 4 committees. And, I will kind of maybe ask you the question later, how many committees have to approve something before Barclays can actually green light? Whereas, you're competing with startups of, 2 or 3 very passionate, very motivated, guys in the mid-20s, mid-30s, that can make decisions extremely quickly. And guess what? If they fail, no big deal. They just shut that business down, start another one. So the innovation, I think the ability to innovate and take risks is the single biggest challenge that the banks have, because banks are terrified, right? I mean, you've got the regulator looking at them. You've got every journalist, really looking to take pot shots at banks. They've got a very high burden of responsibility to the economy, because guess what? If the banks fail, the entire economy is in trouble. So you have a huge asymmetric risk-reward profile for the average bank employee. Every bank and typically bank employees are pretty well paid. So if you look at the payoff, it's all about not screwing up rather than trying the next thing. So I think, if you kind of boil down the case for why peer-to-peer is really going to make bigger inroads into banking than probably even, the consensus in this room, I think it's about that ability to take risks and innovate. And I'd encourage everybody actually, if you want to kind of get the kind of the view that is going to the boardroom of banks, I'm not sure if you read it. There's a fantastic McKinsey report was put out last week, basically just looking at, what are the implications of financial technology for the financial services industry. And kind of in a nutshell, the key point is, 30 or 40% of the revenues within consumer banking could be at risk, and up to 60% of the profitability could be eroded by this industry. And then you just briefly touch on some of the other drivers. I mean, so there's a whole cost efficiency advantage, so it's all about being leaner, meaner, using best-in-class, latest technology. And then, you talked a little bit about net promoter scores. I think that's your area at Barclays, where you're basically working to constantly improve the user experience. I think that financial technology companies are just on that page because they, a lot of the people come from, consumer services industry, so they're naturally thinking about net promoter scores and, how to basically attract the borrowers. And then finally, I mean, the regulator. I mean, it's very unusual for the regulator or the Bank of England to actually come out and support a industry that's relatively unproven. But remarkably, I mean, the likes of Andrew Haldane, who's currently the chief economist at the Bank of England, 2 or 3 years ago, he wrote a paper basically saying, guys, this is the future of financial services, and, we need to get on with this. So as the center of the incumbent structure, for him to come out and say that is really quite remarkable. So you have strong regulatory and strong government support as well. So those are kind of four things that, they're 4 very significant tailwinds for this community.
Okay, so then let's just take a piece of that. We just had the consumer lending panel up here with Zopa RateSetter, Lending Works, and these guys all launched. They're not trying to go after unbankable customers. They're going after, like you talked to, like Zopa particularly. It was prime, even super prime type customers, and this is back before the financial crisis as well. Shouldn't they have not have been able to do that? I mean, if a bank was serving these customers well, shouldn't they not have been able to succeed?
Well, I think anytime someone enters a market and offers something slightly different, you're going to see some shake up and share. I think that's natural to the degree that customers like what it is that's being offered. I think increased diversity in the range of products and the range of services available to customers. Not everybody's going to be wholly satisfied with whatever they get, however good, if you will, the current provision is, particularly if there's a relatively small number of people and let's say a lack of diversity in providing that, particularly to the segments that you described. So yeah, I think it's a difficult thing to argue against a premise that says the growth that we've seen in this form of alternative finance provision is definitely representative of the fact that there were a reasonable number of people who were dissatisfied with either the products or the services that they were getting or couldn't otherwise get access to credit in that way, even if they did fall into the types of segments that you just described, for whatever reason that might be.
Right, and I don't want to feel like you got two sides against you here, because I could easily slip into that role. But I guess to other one of Cormac's points, how is innovation seen, and how is it implemented? Like, how many committees do you have to go through to do something new? I mean, Barclays has been a very successful bank, as you mentioned, for a long, long time. But I presume to be successful for so long, there's got to be some positive attitude towards innovation. Can you explain what is that at Barclays?
Yeah, so I can only speak institutionally, can't speak on behalf of the industry. So Cormac's points may still apply generally, but let me talk about sort of why they may not apply as specifically to us. So let me just address the committee point. For both personal lending and business lending, it's 0. So for both individuals and businesses, we now have pre-assessed limits that are made available through either mobile banking or online banking transparently to the customer. And up to £25,000 at the moment, they can get access to that money instantly.
So are you talking about committee decisioning? Yeah, but I mean, I was actually talking about, like say you wanted to go in a new direction, redesign a website or do a strategic deal. I'm guessing you probably have to go through layers and layers of management committees right? Okay, you're different from RBS. RBS can't even tell you who makes the ultimate decision.
Yeah, so I'm not going to suggest that we're anywhere near perfect. And anytime you've got an organization that has, in our case, in personal corporate banking, 50,000 people relative to a startup that has some significant smaller number of that, is it more complex to be able to outline decision rights and make sure that you're moving at the right pace? But I think that's not an insurmountable challenge. And I think, I would say, again, institutionally, we definitely still got work to do, but we're definitely better than I'd say we were when I started 11 years ago at Barclays. Most of the focus that we've got is trying, NPS is an example of a metric that you might use to do this, but is trying to change bank culture, and I don't think your description is far off the mark around the way it would have been historically, of being process-oriented and policy-oriented to being very customer and client-oriented, and letting the sort of fundamental truths that we hear from customers and clients pull through the organization and let that focus people's minds around what is it that we're actually fundamentally trying to get done. And that's the reason why I use the example of the pre-approved limits and the instant access to credit, because that didn't, that took a little while to sort of get people's mind around the idea that it was possible to do those things, because there were lots of process and policy reasons why it felt really hard to do in 2012 when we had the premise. But now that we've got it in the market, had it there for 2 years, all of the energy now is, oh my God, this stuff is not only possible, it's actually something customers, you would think you would have thought intuitively, but now we've got empirical evidence that they obviously love. And so now how do we build on that? So we'll be doing things, I said at the moment, the threshold is £25,000, we'll be increasing that to £50,000. And anybody who we have a relationship with has now got instant access to credit. Now, we've got access to all the same data sources that you described, so how do we get ourselves in a position so that we can leverage that data to make better informed decisions than we do today, but also to make faster decisions without having to build 12 months of credit history to be able to do that. And again, everybody in the room, I'm sure, is familiar with Payment Services Directive 2 and the implication that's going to have for the sector on
Not really, actually. Can you
well, so Payment Services Directive 2, one of the aspects of it that I think outside of certain sectors is not particularly well known is there's a requirement that's in there that's going to encourage, if not force, banks to open up transactional history on the basis of a customer granting permission to a third party to do that. Now, all of a sudden, if you will, what people might have historically thought of as the competitive advantage of banks, which is their own internal credit scoring mechanisms and the wealth of data history that sits underneath their ability to produce those, is suddenly now, in some ways, going to be available in the public to third parties to be able to develop either product or aggregation solutions, and I'm sure lots of other things that will come out over time. So, I think what banks have to do is not approach that defensively, but offensively, because we only have 25% market share, and to the extent that the competition and the authorities don't disagree with us, to the degree that on a fair basis we can get access to data and we can compete on equal terms with everybody else, that's a great opportunity to grow our business as well. Okay. But it does take a very different attitude to not credit risk, but to, if you will, operational and innovation risk in terms of willingness to try things that you don't necessarily have the. To your point, we're going to have invest in things, and I talk to my team a lot about celebrating failure and the fact that we're going to try some things that, frankly, I have no idea if it's actually going to work. But we're not going to do it for the sake of doing it. We're going to do it for the sake of testing whether or not it does work, and if it doesn't, where do we go from there?
Right. So let's just touch on, keep on innovation. I mean, Cormac, you've been a banking analyst. You now focus on this industry. I mean, what are the key innovations that this industry has brought that banks simply don't do? What does this industry do?
I'm not sure that, well, what does it do? It connects lenders and borrowers without having any capital at risk. And I mean, to some extent, there's a regulatory arbitrage as well, right? So so peer-to-peer lenders are not required to hold capital, against credit risk or as much capital against operational risk. Do have to keep some, and are not systemically important. So I think the requirements to actually make a loan are a lot simpler, and I think that's a key benefit. But in terms of actually doing the lending, I think it's actually probably quite a similar process. I mean, you're still looking at the borrower, you're still doing a lot of credit underwriting, you're still looking at a lot of the same data. So I would say it's not that different from the way banks are doing it. What I would say is that we're using the latest technology, whereas, I'd be interested to know what's the average age of the technology that Barclays or the other banks are using. I suspect you'll tell me that it's accumulated over, potentially 20 or 30 years, and it's, a function of a bunch of acquisitions you've made over time, and some say there's a mentality of just keeping what you've got working rather than trying to use the latest technology. Is that fair?
Well, I definitely think, outside of even a peer-to-peer lending context, I think one of the views on traditional banks is that they are encumbered by two particular legacy issues, legacy IT and legacy assets. Let me just describe it, which is our sort of physical infrastructure and the costs associated with that. And when you've got innovators coming in with the disruption is mostly, not entirely, but largely around business model, because they come in with a very significantly different cost structure and therefore can compete on different terms from a pricing perspective at the very least. There's lots of other things as well, but that's one of the core issues I think banks have to respond to. So we have to figure out how to make our IT infrastructure, make it not an impediment. And there's new technology that we can use that means 10 years ago, that was a very significant question for an organization of our size, because you're talking multiple billions of pounds in multiple years to rip the guts of the accounting system out and put a new one in. Technology means...
But that's money that you don't really have available, though. I mean, in theory, you could do a rights issue, raise a couple of billion.
I don't think we've got a capital constraint in that respect. I think it's more... The other business model, I think, distinction, at least for us, is we don't at the moment, but we've got an executive chairman determined to make sure that we do earn an adequate return on the capital that we do have, and that capital's gone up significantly over time in terms of the volume we have to hold for a given unit of risk.
But aren't you inevitably focusing on the next quarter's earnings per share number or revenue? So you can't afford to take a 5-year view and run Barclays at a loss, to get up the curve in terms of the latest technology. I mean, you're always going to be trying to do it on incremental, gradual basis rather than big bang. Let's rip all the old tech out and put in the new tech, right?
Yeah, so the point I was going to make is there's technology now available that means we don't have to rip the old tech out. You can get the tech to work in a way that is as fast as anything that anybody else has got, and in terms of speed, but also the quality of the capability that it can create to create products and service customers. There's work to do, no doubt, to be able to put that technology in place and get it to connect with all of the back-end systems to effectively push them farther into the back-end so that they no longer matter, if you will. But I would say on the scale of issues that I worry about, that's one of them, but it's certainly not the top of the list.
Okay.
The biggest issue, and your point about sort of quarterly earnings, of course, I would look naive at the very least if I sat up here and said, no, of course not, we think about the long term. But again, that's about balance, because to your point about speed of change, I think we can deliver quarterly numbers and deliver rapid change inside the organization. You've got to be brave, and you've got to take some big bets.
I mean, don't you also have the wrong kind of people, right? I mean, if you look at the workforce of Barclays, and I don't want to be rude, but if you look at, say, average education levels, or academic grades, or work rate, how many hours a week they put in, how much they get paid, their whole mindset, and then compare them with, people in financial technology, who tend to, come from very high quality universities, work incredibly hard, sometimes 6 days, 7 days a week. It's just like you compare, and I would say that's perhaps the biggest challenge you have, that you have the wrong people. And in theory, you could lay off the entire consumer division of Barclays and rehire the right kind of people, but inevitably that's going to be difficult, right?
I think that specifically may be very difficult. So you caveated it saying you didn't want to be rude. That is kind of rude, I think, to the 40,000 colleagues I have across Barclays. Can I go through them?
I didn't say I wasn't going to be rude to people who aren't
here. Can I go through them individually and say that they all fit the criteria that you described? Of course not.
Okay.
But that's also, the 40,000 people we have, they don't need to do the types of things that you want them to do that require the type of skills, capabilities, and experience that you described.
But couldn't you
Can we hire those people in? Of course we can, and we've got lots of them around the organization.
But couldn't you eliminate, more than half of those people that you currently have working for Barclays and replace them with technology?
I don't know whether or not the scale of that ambition is fair or not. Are there, across the whole of the banking industry, is there a significant shift away from human interventions to machine interventions? Of course there is. Mm-hmm. The pace of that, to a comment that you made earlier, is not all within our control because there are political and regulatory constraints around the pace at which we can do that.
Right.
I think
the unions to deal with, right?
Unions to a degree. I think that it's more, I would say the political constraints are bigger in terms of people's perception, I think, of banks as a utility and therefore a public good, and therefore these things are obligatory for us to provide. I think banks are now, braver about challenging some of those norms. And I think, again, the advent of some of the disruption that even in this lending space that peer-to-peer providers helps with that because, ultimately, I think the regulators, as an example, I think for very good reasons, have taken a rather benign eye, particularly in the UK, to how they apply regulations to some of the innovative things that have developed. They need to do that because they want to foster the competition and allow it to burgeon. But at some point in time, that's going to have to become a more level playing field. Mm-hmm. So what we worry more about is the sort of political pressure of, what's governing our ability to make the changes that we need to make rather than our practical ability to execute them.
Okay. Okay, let's switch to small business lending because I feel like that's a topic that you read about all the time, that the poor small businesses are not getting funded by banks, they're getting turned down. What are your, particularly when it comes to small businesses, let's say loans under £250,000, for example, what is the attitude inside Barclays to be able, how can you serve the people who want those kinds of loans better?
So there's a couple of things. One I think, I talked a lot earlier about speed of decision making and some of the changes that we've already made and have had in place for several years to facilitate those clients' understanding and I guess just awareness of the fact that we have pre-approved limits, and if they want the money, that they just need to come and tell us they want it, and then it'll be with them.
But that's for a consumer, right?
No.
That's, okay.
That's for businesses and consumers. So, and we can, as I said, we're in the process of making sure that we test not the operational efficacy of that, but the risk efficacy of that. And so therefore, I would expect over time we'll be extending the limits through which we make that accessible to customers. As I said, we're already in the process of moving it up to £50,000. I would expect by the end of next year, we'll tack another zero on top of that. So we will be in a position within 6 to 12 months to basically take, I would say, 80 to 90% of the credit that we would extend on any annual basis and make it instantly available. So the challenge there is more about changing some of the processes about how you operationalize the ability to get that money into the customer's account as instantly as they say, I want it. That's not the only challenge we've got. There's a huge trust issue. I think that's one of the points I was alluding to earlier that's allowed a sort of people who are already focusing on prime and subprime markets to come into the market and take share is partly price, partly service and speed, but it's partly also people just wanting to go somewhere else, frankly, because they don't necessarily feel somewhere inside themselves that they're necessarily going to get the best possible outcome from their current bank or a other bank. And that's going to take banks, I think, a while to fix. There's nothing we can do in terms of putting up posters to say, get over it and trust us. That's going to take time because we're going to have to put a quality service and a quality product out for a sustained period of time for that trust to rebuild. And that's the biggest, I think the biggest issue of all the things that we talked about, the biggest challenge I think banks have is that. We've, if you will, forgive my French, we screwed ourselves because the banking industry allowed that trust to erode over a long enough period of time that it's got to a point now where it's not in a sort of we're not in a state where it can't be recovered. It's going to take quite some effort to get it recovered.
Well, and obviously this is something this industry has to work on as well, the trust issue. I mean, we're still, it's a new industry. It doesn't have a long track record. It hasn't been around for 345 years, whatever. So that's really an innovative thing to be able to provide instant access to small businesses. They can get potentially £100,000 or £50,000 instantly. So Cormac, how is small business platforms going to be able to compete with that?
Well, they have the same technology, right? And they have a lot less people, so they're just going to be leaner and meaner. They don't have the same regulatory burdens, right? So they don't have. I mean, they can run with a balance sheet model, but they probably can run that balance sheet model with a lot less capital than Barclays can. So they're just going to be more efficient. So they'll probably be able to offer a better rate, and they're probably going to be able. I mean, you talked about celebrating failure. I think the willingness to experiment and really go out on a limb and try things and fail quickly, fail forward. I think like Amazon I think is an example of a large organization that has built experimentation and failure into their operating model. And so in theory, banks could learn to do the same thing, but I think it goes back to having the wrong kind of people. I think the kind of people that go into banking, and frankly, the kind of people you need in banking are people that are risk averse and trying to be careful and thoughtful and very considered. Those are not necessarily the right kind of people to try some new way of acquiring customers, and if it doesn't work, say, okay, that didn't work, let's try 3 other things. So I think that's a very natural advantage. So better rates and basically more innovation. I think that will enable small business lenders, fintech lenders to continue to make inroads. And I thought it was kind of interesting. Larry Summers, at LendIt in New York, was basically talking about he thinks that financial technology or peer-to-peer direct lending companies potentially get to 75% market share in SME lending because they've got a much more efficient model. I'm kind of slightly skeptical actually when you say that you have the ability to make £100,000 loans to SMEs, on a kind of fully straight-through process, instantaneous basis across the entire Barclays group. I mean, I completely accept that you probably within certain verticals, perhaps areas that you're working in, you can do that. But I suspect across the entire bank, there's a lot of human interaction required to actually sanction a £100,000 loan. I mean, can you confirm that Barclays can do instantaneous £100,000 loans across the entire group, or is it, really just in kind of best practice group that you're focused on?
So it depends on what you mean by group. So the way we would be organized is we've got our UK personal and corporate banking business, our African business, in terms of the types of SME businesses that we would be doing. Of course, we've got an investment bank as well and a credit card business that we're not really talking about in this space. The point I made is we specifically do it up to £25,000 today. That's across our entire SME book in the UK. There's no specialization or segregation within that. And then £50,000 is where we're moving to. And the comment I made in response to your question was we're working right now to get to a place where we can do that by significantly increasing the volume, the limit, if you will, that would then apply to. Again, I can't confirm that we're doing it today. I can confirm an anticipation that we'll be able to do that up to very significantly higher levels within at least 12 months, I would say.
Okay, and maybe the other thing I forgot to mention actually is the other advantage that fintech companies have. We're probably willing to take more credit risk, so I think, the regulator might get nervous if Barclays starts, lending to the types of SMEs that you should charge a 50 or 60% APR to. Just because it looks risky. They look at the balance sheet. The company's potentially losing money. They've only been around for a relatively short period of time. But at the right rate, you should lend to that SME. If you're BlackRock and it's part of a big portfolio on a diversified basis, it makes sense. But I can imagine that regulators second guessing everything a bank is doing because you're systemically important probably wouldn't really let you make those kind of loans. So that's I would say that's probably a natural advantage that fintech will always have.
Yeah, maybe. Let's see a cycle develop and then let's make that decision. I think that before a regulator would intervene, I think my chief credit risk officer and Robert LeBlanc would probably step in before we started lending on those bases. Look, you only have to go back to the financial crisis, and this isn't a comment about, I don't think, peer-to-peer specifically, but just in that specific vein. one of the reasons why we are where we are in the dialogue, at least in my view, around SME lending in the UK is there were lots of alternative finance providers that existed pre-crisis that don't exist today. And the main reason was because they lent money to people at rates that they shouldn't have lent money to.
Are you sure that's, I mean, I thought...
I can show you the statistics.
Well, I mean, I speak to a lot of these guys that actually failed at that point in time, and what they say is actually that their liquidity lines that they had from banks, or they thought they had from banks, actually disappeared because the banks were in trouble, actually. So if you actually look at the credit data of someone like OnDeck or some of the others that actually operated through that period, they didn't typically have a horrendous financial crisis. I mean, if you look at the data, it's online, the loan losses went up a bit, but not enough to basically blow up the model, actually.
Yeah, so we can spend a long time, I'm sure, unproductively having a debate about whether it was a credit problem or a liquidity problem. It's ultimately the same thing, which is money was heading in places that it shouldn't economically have been heading. And whether or not that was manifested itself at the final moment because somebody withdrew a liquidity line, I think is neither here nor there. The fact of the matter was there was an overextension of credit. I'm not suggesting that we're in a model right now that's heading back towards that. I'm just suggesting that when we look at, and the people in the room from those organizations would have a view, when we've gotten close, the government right now is obviously working with banks to think about a referral service so that to help with this SME lending issue.
Can I
just let me finish. So one of the things that they're working on as a part of that is to say, go get to know some of the platforms to whom you could refer that. When we get close to some of those platforms, their credit risk profile is ultimately exactly the same as ours. And so as a consequence, we sit back with the government and say, well, who are these alternative lenders that you want us to send, if you will, the people that we're not willing to lend to? I'm sure there are some in the room that will be willing to do that. We haven't seen anybody, I think, yet that we've believed to be a really credible provider of credit at that level of credit risk.
I'm not sure that's fair. I mean, if you look at the likes of Funding Circle, I mean, they're starting to build up. They weren't very good at SME lending when they started, but over a period of time, they've actually, every cohort, they look like they're getting better. You could say part of that is just the general macro getting better, but I think they probably are just getting better at doing the underwriting. I just want to pick you up on a point. You said that during the financial crisis, a lot of these businesses failed, and, it doesn't really matter. Basically, I think you were saying basically that the capital was getting misallocated, and therefore, this kind of lending shouldn't really have been happening at that, during the financial crisis. Where to some extent, we had the financial crisis because this kind of SME lending was getting done by alternative finance. I would actually challenge that. I would say that what really happened, and I was a banks analyst during the financial crisis. A lot of what happened was, senior management at the likes of RBS and Barclays and Lloyds and other places, making some very large real estate bets, because they had an asymmetric payoff. If it went well, they got large bonuses and share price went up. If it went wrong, basically the losses got socialized. And because of that, they ran into very massive capital shortages, and therefore they had a liquidity problem. And then they were forced to pull lines to companies that were actually very healthy, but basically they had liquidity problems, so they had to pull those lines. And to a large extent, that's why some of these alternative finance companies failed during the crisis. It was actually that the senior management of the banks made errors in terms of underwriting. It wasn't the alternative finance companies.
Anyway, we're not going to go there. We're pretty much out of time, but I just want to get, before we finish, I want to get like 30 seconds from each of you where banking is in 10 years' time as it relates to this industry. I mean, Samira said they're going to do £100 billion, $100 billion, I think, a year globally at Funding Circle in 10 years' time. So 30 seconds, where is this industry in 10 years' time?
I think in 10 years' time, banks will be having their Walmart moment, where, basically we've seen Amazon actually start to really make a dent in Walmart. I think, banks in 10 years' time will be where music stores and bookstores are today. I think they'll be kind of looking around saying, gee, what happened? And, I think a huge proportion of consumer finance, perhaps 30, 40% of consumer finance, and I think maybe over 50% of SME will have migrated onto some form of financial technology-enabled platforms.
Matt?
So I guess I start from three things. I think in 10 years' time, we'll have been through a credit cycle. I'm not predicting when it's going to happen. I would say within 10 years, we probably will have. And as a consequence of that, I think we will see the whole lending sort of ecosystem sort of shape up differently as a consequence of it. I think, two, I think you're going to continue to see growth. I said that right at the outset of this conversation in alternative finance providers, so-called peer-to-peer lenders. What share they take, I don't know. Is it going to be higher than it is today? Without doubt, would be my guess. I think what's going to be interesting is as that continues to develop and mature, how do the business models evolve? Because I think right now, most of the business models from a revenue perspective, they require flow. And when you get to a point where that share is matured and there isn't as much churn, if you will, in the system, what's the business model shift to? Because it's a beautiful business model to have revenue on the basis of fees taken from loans that you've intermediated, but when there aren't as many loans to intermediate, what do you then do? And you know, banks have always been that intermediary player, and I think we've got lots of experience at the upper end of the corporate market playing an intermediary role, getting those fees and securitizations, and I don't think this is anything other than an instant securitization sort of process, if you will. So I think there's going to be some maturation around those business models. My suspicion is you've got a sort of Cambrian explosion of innovation right now and lots of different players coming into the market, and in 10 years' time I suspect that will have consolidated quite a bit and you'll have a couple of big names that become the sort of winners, if you will, in that shakeout of market share.
So in that analogy, the banks are the dinosaurs?
Could be. They've certainly got a risk of being that. I think the good news now is we know the meteor's coming and we're going to go figure out how to protect ourselves. So I think the big issue for, I think, banks is trying to do exactly that, which is understand what the market's telling us right now, understand what we have to do as a consequence of it, and get damn fast at doing those things.
Okay, well, on that note, thank you very much, gentlemen. Appreciate it.
Thank you.